Welcome to Careers and Finance Podcast. I'm your host, Daniel Hollett, and today I have with me Jonas Daly from Bennelong Funds Management. Jonas, welcome to the show. And I would love to start off with hearing your story and background and how you got to where you are in your role there at Bennelong.
Thanks, Daniel. Good to be here today. My role at Bennelong is Chief of Distribution and Marketing. So I run a team here, which is around 13 in total, which covers obviously the advisory market, but also the institutional market. Been in the role coming up to 10 years now. So obviously covered a lot of ground in those 10 years, but it's been a good journey here at Bennelong.
Yeah, nice, mate. And obviously that's a fantastic role that you have there, but I imagine you had some much more humble beginnings in the front end of your career. Tell me about where you started and how you found your way into funds management.
Yeah, sure. Going back kind of, I've always been interested in financial markets, even as a teenager, and first traded a share back in the day, which was Westpac Bank. I think it was the first stock that I bought. My dad was pretty close to the market, and he was an actuary by trade and loved following the stock market. So we used to follow the stocks in the back of the newspaper. Back then there wasn't a lot of electronic screens or computers to follow it as we do have now. And obviously used an old stockbroker in those days and paid way too much stock brokerage for the tiny amount of shares I bought. But it was very interesting to kind of just have that interest in the market. And then from there, while I was at uni and studying, I actually, funnily enough, worked for Westpac, just more in the retail kind of banking units, just on that side of things, but had a interesting role where we used to put the checks through the big machine, which was the size of a car, and package up those checks to send them to head office and for processing. So, and obviously, you had checks that bounced, and they were bounced by the local branch manager rather than electronically as they are today. So I don't even think many people use paper checks anymore. But yeah, so it's interesting that kind of entry into financial services. And then there was another role at Westpac working in the wholesale currency notes section here in Sydney, and there's a massive vault underneath the Met Centre. It was the old Westpac Plaza, and it's probably still there, but that's where all the foreign currency notes were held, and there was just pallets of US dollars in there. You've never seen so much in your whole life, but every currency from around the world, even those little kind of tiny currencies, the rupees and what have you. But that was an interesting experience too, just working in that foreign currency area, and so that was interesting. And then from there, kind of graduated with a Bachelor of Business in marketing as well. So always been interested in the marketing side rather than that kind of analytical side. Has been more about kind of relationship building and sales and marketing, and completed that. But then also from there started a career at BT Funds Management, and again that was more on the advisor line there. So just starting off, learning everything about what there was to funds management, and then getting closer to the investment teams and understanding, how investments, all the different asset classes and investments and how they're valued, right through to, sitting with the investment teams and just understanding performance, what's driving them, whether it be macro or the bottom up stock picking. So that was where I started the career at Beats, and then from there kind of ventured overseas.
And then how did that overseas time kind of shape your journey? A lot of Aussies go the backpacking route and want to spend a few years abroad, and for a lot of them, it's a very enriching time. Is that what it was for you? Was it a good value being over there?
Yeah, look, it was good. And look, I did put the backpack on, and there was a few mates from school. We went over there and basically around Central Europe, which was a great trip. And then finished in London for the 99 World Rugby World Cup, which was fantastic.
Very nice.
To see the Wallabies win that one. So they finished with the final up in Cardiff Arms, which is Millennium Stadium. So that was a really nice thing to watch, and as well as the semi-final at Twickenham. So that was fantastic. And then from there, it was really couple of roles in London. Barclays Global Investors was one of those, and also working for Reuters, which was on the media kind of marketing content side, building products for financial advisors like wealth management products. So that was an interesting part of the journey there too. And then also around that time was the .com boom. And so there was a lot of new websites and financial websites and trading websites being designed. And so I did also work for a risk management software business that was really focused on like a derivatives trading platform set up by a bunch of guys out of BNP Paribas, and that was more on derivatives and risk management. And again, on the marketing sales side, so distributing that product in London to prop traders and also some of the asset managers that are using derivatives to hedge out positions. So that was an interesting part of the journey as well. But loved my time in London, about 4.5 years, and then made the trip back to Australia.
Yep. And then coming back to Australia, I know you jumped kind of further into the funds management piece and had a good stint at Colonial First State.
Yep.
How did that sort of set you up in terms of, re-entering your career, and what were those big sort of key factors that have allowed you to build such an extensive career in sales?
Yeah, look, I think working around going to London and starting off in funds management was a good start, but then doing some travel and understanding how other markets did it as well. Obviously it's a different market in the UK as well. And then coming back, I actually came back and did a little bit of work initially for Reuters as a bit of a handover in Sydney. And then I accepted a role at the Sydney Futures Exchange. And that, again, was on that sales and marketing side. And the role evolved into a Asia Pacific regional sales role. So I was going up into Singapore, Hong Kong, and Tokyo. They were my primary markets, distributing the futures exchanges products. So everything from 3 and 10-year bond futures, the SPY index futures, 30-day cash rate, and there's a few commodity futures products as well in there. So that was a really interesting part. Again, understanding more on the capital markets and the derivative side and how the interest rate markets work here in Australia, and then other parts of Asia, because obviously you're kind of looking to position those in with other products that were being used up in Asia, like the Kospi and some of those more exotic products and futures contracts up in Tokyo, for example, and orange juice futures and all sorts of things, and also a bit of relationship management with hedge funds and the commodity trading advisors and then the natural hedges of the banks and those trading the flows on some of the investment banking desks as well. So that was a really interesting part of probably one of the most interesting roles that I've had. And then, that was, something that I wanted to use some of that experience and moved into the hedge fund sales area with a couple of groups in Sydney. And that was literally just before the GFC. So that was also a huge learning curve. I worked for a credit fund here in Sydney, and they were right in the middle of the credit storm that came through with the GFC. And that was, again, like an amazing experience, a pretty scary experience, but learned a lot about obviously what drove those collapses in the credit markets. And that's helped, me more recently with, what we're seeing in credit now and private markets. Obviously, the private market industry is still, thriving, and private credit in particular. Yeah. And a lot of that private debt market was really kind of formed now out of the GFC because there were a lot of lessons learnt. And so, locking up funds and, having less liquidity and getting the structures right and not, necessarily having that exposure to public markets is a good thing because it protects investors. So that's why a lot of the private debt funds, have still survived, and if anything, have kind of flourished since we had that big correction in the credit market and during the GFC.
Yeah. Yeah. And then, mate, you've gone on the global journey there. You've sold just about everything under the sun. Are orange juice futures a real thing, or is that a reference to something?
No, that's a real thing. There's prawn futures, there's all sorts of things, and there's even obviously water futures that we've had exposure to in Australia. And but yeah, there's if you go into the Tokyo Commodity Exchange, TOCOM, you'll see a long list of futures on everything, and you obviously anything commodity, coffee beans and all that stuff's more larger, but there are very much and obviously the Chicago exchanges are even bigger. You'll find there's a future on nearly everything. So you got all that, obviously all the commodities, all the ag commodities, of course. Yeah. So it's interesting.
Amazing. And then, mate, give the kind of high level on Bennelong. I know you guys are a multi-fund, multi-asset, but there's quite a few strings to the bow there at Bennelong. Can you give me almost the 60-second rundown of what you guys are doing at the moment?
Yeah, definitely. Firstly, Bennelong is a business that is privately owned. It was founded by Jeff Chapman. The Chapman family is the family office that's behind Bennelong. It was originally, basically 20 years ago, Jeff was looking for somewhere to park a lot of his private money that he made a lot of money in sports media, also
Yeah.
invested that into a lot of a lot of real estate on some of those golf courses, mainly in the UK. And so Jeff decided to put his money into a pairs strategy, which was basically a market neutral, which then turned into a market neutral fund. So that was the first product down in Melbourne. And then he started building a funds management business and saw the opportunity from there. And then also looked to get a long only Aussie equity fund up and running. So he basically formed that team with Mark East, who came out of ING. So they were the first two funds that came on board. And then since then, we've diversified the business further into other asset classes, including we've got global property, so listed global property with key global investors. We've got 4D infrastructure, which is listed infrastructure globally as well, with a tilt to emerging markets. So they're based here in Sydney. And then we also have a number of other strategies. We've got one in particular that's come on more recently, Canopy Investors, who three guys that have come out of Magellan, focused on global small and mid caps, so SMIDs as they're called. So we've also incubated a new fund there, which is exciting. And then also looking further afield, where we are going into more partnerships rather than just taking equity stakes and then building out these businesses from scratch. We think, well, look, why don't we partner with some of the best managers in the world who are specialised in a certain asset class? So instead of trying to incubate something very specialist such as ILS, which is insurance-linked securities, cat bonds, we've partnered with one of the best globally, who are already running $5 billion in the space, have specialists that cover all those weather events. And so we've recently partnered with that group called Leadenhall and bringing that to the Australian market, both on the institutional side and the wholesale side. And then more recently, we've also got into partnership with a group called Allspring, which is a massive giant of a business. It's a spin out of Wells Fargo, which is one of the biggest banks in the world, the biggest. So they are running 1 trillion Australian dollars in fixed interest, but some other equity products as well. But most of it is fixed interest. So we're bringing out a global income fund, which is public market. So it does have that liquidity, which obviously is important for the various platforms and many of the dealer groups still. And then also in that category, but more so on the credit and private debt side, we've partnered up with a group called Monroe Capital, who are based out of Chicago. 20 billion USD they're running at the moment, more in that lower middle market loan segment, which does give you a higher yield. But because it is in that lower middle market side, with the lending basically to companies with 30 million EBITDA, around that kind of is probably the minimum, and upwards they're looking to invest and obviously lend money to. That provides a really nice yield, because most of the companies that come in at that level only really want to borrow the money short term because they're looking to IPO or they're looking to kind of move further up the curve and then obviously negotiate better rates. But what we do is have really high covenants in place, or the Monroe guys have very high covenants in place. There's a huge amount of documentation that really protects them as a lender, and obviously they do a huge amount of quality checks around it. And then obviously all the transparency that the US have to provide, so all the loans, the names of the loans, the risk profiles, 3 independent valuers that the Monroe guys use. So that's exciting to bring more recently to the market. So we're just going through that process now of doing a feeder fund and basically bringing that to the market. And then also going further afield, we will look at other private markets and seeing, obviously based on what investor demand is. So that's something we'll look to down the track.
Yeah. Sounds like you guys are having to be very, very agile at the moment. Got a lot in the works there, and bringing forth some really best of solutions. Really chasing those. Yeah, who are the best of in all of those different categories.
Absolutely. And obviously we're mindful of crossover too, and we try not to cross over within the group. So it's obviously making sure that we've got something and also making sure we've got a contemporary product mix. So it's obviously there is demand for private debt and income at the moment. And so that's why we've partnered up with Allspring and also Monroe Capital.
Yeah. Nice, mate. And that probably leads us into a great question really related to finance as a whole. And we've seen this large rise in the private market space. And so obviously you guys are starting to bring solutions to the table around that. There's been a lot in Australia around particularly your real estate private credits. But how are you guys, what are you seeing in the market, and how are you positioning your funds around that?
Yeah, sure. So what we're seeing is you've got different liquidity profiles that that need to be considered.
Mm.
So obviously different investors have different requirements. So obviously on the institutional side, the industry funds for many years have been investing in, non-liquid assets and taking big infrastructure investments in airports and toll roads and the like. And then you've also got the private wealth sector that have probably been the first adopters of private markets, because they also have clients that, have long horizons and basically are happy to kind of, put something in the bottom drawer that, has got long-term benefits. You get rewarded for that longer lockup and illiquidity. So that's something that's been popular in the private space and that private client space. But they of course still have very short duration assets and cash, and some will have gold. And obviously these big families, still have a very controlled asset allocation, but they do also have private equity and private debt in their portfolios as well. So that's first of all the area of like what are the clients looking for? So that's insto and then the private market. And then you've got the dealer group side. So those advisors, who typically use platforms and, have clients that, require more daily liquid and, obviously full look throughs on the full portfolio, are very, very sensitive to valuations as well. And also the
Mm.
platforms themselves, some platforms can only process those daily liquid funds as well. But there are many platforms now accepting less liquid options. So whether it's big quarterly
Mm.
liquidity or longer lockups, that's certainly coming through in the platform space. And also different wrappers, so information memorandums are being accepted as well. But obviously at the same time, they need to make sure, especially on the super side, that they've done the due diligence from a trustee point of view and make sure they're comfortable with the assets and obviously how they're being delivered and what the structure is, because a lot of these issues that are formed that pop up are really due to liquidity. If you look at the GFC and look at
Mm.
recent events, whether it's property related syndicates and structured products and all these types of things, usually it's something that's triggered. It's like a run on redemptions. Again, that's liquidity. You need to sell something quickly.
Yeah.
Whether it's a stock, it still happens in the small cap space. I've seen it happen even in the large cap space. And then obviously, when you start getting into real estate assets as well, you might have to, sell a big lumpy asset to meet redemption. So that's probably the main thing to consider here, is actually really understand the liquidity of the underlyings, and us as providers, product providers and investment managers, we need to make sure that we get the structure right, but we also display the terms and conditions in the correct way, and really have those up front rather than being in fine print. So if it's a 5% limit on how many redemptions, 5% of NAV is the limit on redemptions, then let's get that right up the front of the presentation, put it in the terms, and really make sure that those advisors or those direct investors or institutional investors even know what the terms are, so that they can relay that to their end client. So that if I've got, if that advisor has a retiree, for example, in there who may be very sensitive to liquidity, they can understand exactly when they can get their money out, rather than after the event of something happening to that person or their estate and realizing that they can't get their money for 3 years. So I think that's something that, people still fall into the trap of really getting the liquidity profile wrong for their clients.
And in that private market space, what is it that is attracting so much attention? It's got
Yeah.
so many investors right now want to be moving towards private market. And I would say it's particularly private credit more than equity because of the liquidity space. But kind of what is it that's caught everyone's attention in this space?
But firstly, like on the income side, like the private debt space, I think it's just obviously the yield is very attractive. That's the first thing.
Mm.
Most of these behind there, most of them are backed by assets, and they're pretty solid assets as well, or a good business. And that's something that's probably been the main attraction, is that high yield. And obviously without going up into equities, it's probably a safer place to sit ahead of equities, as long as there's not a massive amount of defaults that come through. And obviously, some of these loans kind of turn into equities, as we know. So there's been a lot of publicity around that, of going, well, am I really owning some debt here, or am I owning equity as well? So there's been a few of those things that have popped up as well. But it's mainly the yield, I think. And then obviously on the private equity side, people are attracted to kind of or even venture capital for some of the wholesale investors that, obviously getting in early at the ground floor on some of these exciting opportunities. Again, going back to liquidity, you get the reward for, getting in early and locking your money up. And and really backing
Mm.
these companies early. So that's again on the equity side, something that's attracted people to the private markets. And then you go into infrastructure as well, which is becoming popular again. It's always been popular for industry funds and that non-listed private side. I mean, private markets have been here forever, but it's more bringing them through into the private wealth sector where that popularity is increasing. So yeah, it's really, I suppose, it's just being rewarded for being locked up, getting access early to good deals. But again, if you're there to stump up the money, then you get early access to the deals as well. And sometimes there's just not enough capacity in these deals, so they might say, look, we're only going to offer 100 million of equity or debt, and so sometimes there's a rush to get your money in and get that yield or get that attractive valuation of a business.
Yeah. Yeah. And mate, one of the other big themes, I suppose, other than private markets that's been going on and really surged since the Royal Commission into Financial Advice is this space of asset consultants and the role that SMAs are now playing, the separately managed accounts, the role that those SMAs are now playing across the financial advice industry. What have you seen? What's kind of the good, the bad, the ugly? What's working really well? What are the challenges they're facing in that space?
Yeah, look, I think I'll start with the good. I think, these managed accounts and SMAs are really bringing a lot more sophistication to the wholesale and retail market. And usually they're backed by consultants who are, know what they're doing. They understand the macro challenges or what's happening on at the moment. And then so they can either do that tactical asset allocation, but also that strategic allocation of the portfolio. So that's the first thing. And then secondly, obviously, which instruments to put into those portfolios. So if it's a diversified portfolio, so these are managed portfolios, they really kind of can get in there and tailor something for the dealer group or for that particular client. So that's where I think the best benefit is the tailoring. I think that's where they differentiate themselves compared to the kind of traditional multi-sector funds that you could get from a lot of the major platforms. A lot of these consultants are coming in and tailoring these portfolios, and they are still coming out with, your high growth and balanced portfolios, but then they can also go in and tailor particular portfolios. They can also do direct share SMAs, so they can get full look through on the portfolio of the shares so that the underlying investor does have beneficial ownership. So then they can screen out certain companies, whether it's ESG related or it could be a director of a company that is not able or, not permitted to own that stock. All different reasons. They can again tailor these SMAs managed accounts. And then finally, it allows the advisor to make those changes very quickly. If there is an obvious crisis looming and you need to get out of something or, rebalance or take a bit of risk off the table, they're able to make those changes. And then those changes basically hit all of the underlying clients as quickly without as much documentation, because again, the client's given the permission to kind of be a part of this managed account, and so they get the benefit of that dynamic asset allocation.
Yeah, they're definitely a product I was around back when I was a financial advisor. They seem to really genuinely create a win-win.
Yeah,
it kind of moves that investment brains trust out of the fund manager and into the advisor's back pocket to be able to kind of go, hey, you sit in front of a client. It's like, hey, we're using some very, very intelligent guys. A lot of really smart guys have come out and built these consultancies. Who deeply understand risk and all of the problems in a portfolio that at an advisor level, you sit through their presentations and you're like, wow, there's about 30 things I had not thought of that could be a problem in the portfolio. And these guys have nutted it all out. And
exactly.
So it's one of those products I'm like, oh, if that was around, maybe it would have hung around a bit longer.
Yeah, definitely. And I think also too, I think so. You're spot on there, Daniel. I think like you look back even, managed accounts have actually been around for a long time, because if you look at some of the old master trusts that have been set up and they had mandate structures there, and they had a multi-manager team or a multi-sector team that literally created these structures, these buckets, if you like, and they were kind of changing the weights between the buckets. They were negotiating fees. They were effectively constructing these managed accounts. So that they have been around for a long time, but I think it's more bringing them through to the advisory, obviously in the managed portfolio side, because literally at the end of the day, it is a model portfolio at the end of the day, instead of being like a multi-manager, if you like. So it is a bit different, but you'll find that it just provides more flexibility. I think they're here to stay. I think We're seeing
Yeah.
more efficiencies created. That's another positive for the practices. So it actually makes them more efficient, allows them to cover more clients. Obviously, they're running a business, so it makes them more profitable. But also they can obviously have that asset consultant sit within their business or on their investment committee to also help them, to get the investment part right, so they can focus on everything else from, deceased estates to financing for the client, all the things that they do as financial planners. Then they can kind of outsource the investment piece to some degree.
Yeah. Yeah. And I think, wrapping that one up, I think there's also such a level of professionalism they bring to investment advisory.
Yep.
There were many, many times I would see a super portfolio or investment portfolio, and you would just stare at it and go, who built this?
Yeah.
And sometimes it was the investor. Sometimes they had done that, but you would see portfolios with kind of 3 different funds all allocated to Australian equities.
Yeah.
And these incredible overlaps where between those 3 different funds there was probably 20% diversification.
Yeah.
80% of it was just the same thing purchased 3 different ways. So I think there's a great level of professionalism they've brought to the industry. So it's very
Absolutely.
good. And mate, last one I want to touch on, and hoping you can give us a little bit of insight into what Bennelong's working in this space. We've seen a massive rise in ETFs, and you and I were actually talking earlier about the next generation of investors coming through may not actually ever use a traditional platform. It may be apps and direct through your Robinhoods or your Stakes or your those kind of direct brokers and using. So mate, tell me about what you guys are seeing there and what Bennelong's doing in the space.
Yeah, look, I think ETFs, you're spot on. I think we've got to think about the future and what the next generation of investors look like. I know my teenage sons, they've already asked me about ETFs and Dad, how do I transact on an ETF and which ones should I buy? So look, I see it as another platform, another, obviously way to access the underlying funds and the portfolios and access. So we will look to do more in that active ETF space. So if you think of ASX as another big platform, it opens up a few different segments. You open up the broker segment, the self-managed super segment, self-driven segment. So yeah, look, I think it makes sense. And look, it may not be massive flows initially, but it is, again, if you treat it more like another platform, it's definitely something to consider. And so we will look to do more in that sector and launch products for each of our groups going forward. If you look at, we've got groups again on the global side, whether it be Skerryvore on the emerging market side, a top rated manager that's based up in Edinburgh. They've got a low risk approach to emerging markets. So making that available in an ETF here in Australia makes complete sense, because obviously the Australian investors typically can access ASX and ASX stocks, but emerging markets is a little bit harder to access, or a lot harder. And obviously brokerage costs to do it yourself is very difficult. And with G-REITs, again, you've got the key global team that can do something there, wrap it up in an ETF and you get that exposure to again, an active manager. And that's a nice concentrated version. And then potentially too on the 4D infrastructure side, you're getting listed infrastructure with a good chunk to emerging markets infrastructure. Again, trying to get access to those assets yourself would be difficult. So again, it makes sense to wrap them up into an ETF and offer those as well. So I'm pretty positive on that sector in general.
And that sounds like that's going to lead to, putting your marketing hat on instead of your distribution hat. There'll probably be a push for marketing in that space, because those ETFs are going to appeal to quite an unadvised market, most likely.
Yeah, definitely. And that's funny. I had a meeting today exactly on that point, looking at how we market some of these ETFs. And, it is, you're going into different segments. You are doing a little bit more of a broader advertising push rather than going down the B2B for C market. So you do need to consider that direct market and potentially other channels through some of the brokers and, promotion, with the ASX and the like. So, yeah, and there's also some new providers coming through. It's not just the ASX as well. You've got a few other groups that are pushing different products down here as well, and offering local fund managers access to their platforms as well. So it's really interesting in the market. I mean, looking at some of the more narrow, obviously segments, in the kind of passive space, when you can do all talking about before orange juice futures and the like, you can get an ETF on video gaming and all sorts of stuff, which and some of it can perform well, or cryptocurrency as well. So, it's an interesting space. But again, we're going back to the active funds management sector. We're offering, high conviction portfolios, stock picking within those portfolios. So it is a very different offering to obviously your index ETFs and those particular sector ETFs. So there's no plans to offer those via Bennelong anytime soon. We'll let the big boys fight that out and compete on price.
Good stuff, mate. Good stuff. Well, Jonas, thank you so much for coming on the show today. I really appreciate your time, the insights into your career all the way back to stacking pallets of US dollars.
Yeah,
and
that's right.
Now working in distribution at one of Australia's kind of premier fund managers. And so, mate, thank you so much for all your time and all the very
Daniel.
best.
Yeah, thanks, Daniel, mate. Thanks for all your help and congratulations on the business. It sounds like it's going really well, and thanks also for all your work recently over in WA that you've done for Bennelong, and also I know that you cover in other markets in South Australia and Victoria as well. So yeah, we love working with you on the team. So thanks again, mate.
Mate, love it, and look forward to doing it again soon. Thanks so much, Jonas.
Cheers, Daniel. See you, mate. Have a good one.
Bye.